Most people enter trading with excitement, believing they will make fast money. But as time passes, they realize the reality is very different. Today, we're going to talk about why most traders don't make profits, why they lose money again and again, and why the market feels like it's always against them. And most importantly, we'll understand the psychology behind these mistakes. Because the biggest losses don't start on the chart, they start in the mind. When a new trader enters the market, the first emotion that controls them is greed. They start thinking that trading is a shortcut to becoming rich. They see green candles and feel like they already understand everything. Without a plan, without knowledge, and without a strategy, they take trades just because the price is going up. This greed creates an illusion of confidence, and confidence without skill always leads to one thing: loss. Another major reason traders lose is lack of patience. Most beginners want instant results. If they enter a trade, they expect the price to move immediately in their direction. But the market doesn't care about anyone's feelings. It moves in its own time. When the price pulls back or moves slowly, fear enters their mind. This fear forces them to close trades early, even if the trade was completely valid. The result? Small profits, and later, bigger losses, because the same fear doesn't allow them to exit quickly when the trade goes wrong. One important psychological reason behind losses is overtrading. After a loss, traders feel the emotional urge to recover the money immediately. This is known as revenge trading. Instead of analyzing what went wrong, they start jumping into random trades, hoping that one good trade will fix everything. But the truth is, the mindset of recovery always leads to more losses. Trading decisions made with emotion are never correct. Revenge trading destroys accounts faster than any bad strategy ever can. Then comes the problem of lack of discipline. Every trader creates rules. I will only trade this pattern. I will use stop loss. I will not trade more than 3 times a day. But when the chart starts moving fast, all the rules disappear. Suddenly, the trader thinks, let me try one more trade. Maybe this one will work. They break their own rules, and slowly they start building a habit of inconsistency. A trader who cannot follow his own rules can never survive in the market. Discipline is not important for trading, it is everything. Another big reason traders lose money is because they don't understand risk management. Most people risk too much money on a single trade. They put 20%, 30%, sometimes even half of their account into one idea. If it works, they become overconfident. If it fails, their account gets destroyed. Successful traders know that the game is not about making money quickly, it's about staying in the game. Risking small but consistent amounts creates long-term survival. But most beginners risk too much and burn out early. One of the most common psychological traps is FOMO, the fear of missing out. When traders see a big move already happening, they feel pressure to enter instantly. They worry that the price will run away without them. This fear pushes them to chase the trade, entering at the worst possible level. And because they enter late, the market pulls back and hits their stop loss. FOMO is powerful because it feels like opportunity, but in reality, it is just impatience disguised as excitement. Traders also lose because they don't have a clear understanding of themselves. Trading style must match personality. If someone is impatient, scalping will harm them. If someone is calm and slow, long-term trading might frustrate them. But most traders copy others instead of understanding their own strengths and weaknesses. They follow random strategies from social media, try 10 different methods in 1 week, and end up confused. Consistency can never be built when the trader keeps switching direction every few days. Another deep psychological reason behind losses is the inability to accept being wrong. When a trade goes against them, many traders keep holding. They keep hoping it will come back. The human mind hates accepting failure, and that same ego pushes the trader deeper into losses. A small loss becomes a big loss, and a big loss becomes a disaster. Successful traders don't try to be right, they try to protect their capital. But beginners try to prove the market wrong, and the market always wins. Most traders also don't review their own mistakes. They don't keep journals, they don't track their emotions, and they don't study their losing patterns. Without self-awareness, the same mistakes repeat again and again. The market punishes repeated behavior, and traders who don't analyze themselves keep falling into the same cycle of loss. Finally, the biggest reason traders lose is because they expect trading to be easy. They believe a few videos, a few indicators, or a few months of experience are enough to beat professionals who have spent years studying behavior, psychology, and strategy. Trading is not a quick skill. It is a long-term mental discipline. The ones who treat it like gambling lose. The ones who treat it like a profession survive. In the end, most traders don't lose because of the market, they lose because of their own mind. Fear, greed, overconfidence, impatience, ego, lack of discipline, and emotional decision-making, these are the real reasons behind losses. When a trader learns to control these inner battles, the outer market becomes much easier. The journey of a profitable trader doesn't begin with charts, it begins with mastering emotions. Only those who can control their mind can control their trades.